Welcome to the deep dive. Today, we're going to tackle a scenario. A scenario you guys have asked about quite a bit, and what's a little intense, honestly.
Yeah.
We're talking a stock market crash triggered by Donald Trump.
Yeah, you're not kidding.
We've got some analysis from financial expert Mark Tilbury, and
there's a lot to unpack.
Yeah.
A lot to unpack for sure.
We're going to do our best.
Yeah, and we want to be clear up front. Like, we're not taking sides politically here.
Oh, for sure.
It's really about understanding the economic forces that Tilbury outlines.
Right.
And then, like, how that can actually help you make, good decisions about your own money.
Exactly. Tilbury identifies three major triggers for a potential crash.
Okay.
We're going to go through each of them.
Right.
The interesting thing is he also sees opportunities, amidst all this chaos.
Interesting.
So we're not just going to talk about what could go wrong,
right,
but like what you can do to protect yourself and even come out ahead.
I love that.
Yeah.
Let's dig in.
Okay, so trigger number one, trade wars.
Oh.
Tilbury really zeroes in on those escalating tariffs.
Yeah.
Especially the ones on Canadian goods.
Uh-huh.
And he makes this pretty stark comparison to the Smoot-Hawley Tariff Act of 1930.
Oh, yeah.
Which, of course, everyone knows contributed to the Great Depression.
Right.
So that's a little scary.
Yet what's interesting is Tilbury actually shares a personal anecdote.
Oh.
He talks about how tariffs have impacted his own business.
Really?
Which I think is great because, the goal of tariffs is often, to protect domestic industries.
Right.
But the unintended consequences often hit everybody's wallets.
Oh, for sure.
He uses this great analogy. He talks about how your grocery bill could just skyrocket.
Oh, yeah. It makes it real.
It does.
Yeah.
It does. And, if we kind of zoom out a little bit, this protectionist approach could isolate the U.S.,
oh, yeah,
on the global stage.
Right.
And it could push other nations to form their own alliances like we're seeing with the BRICS nations, Brazil, Russia, India, China, and South Africa.
It's a powerful bloc.
Huge bloc.
Huh?
And as their influence grows, global trade could shift. That could impact the U.S. dollar.
Right.
And ultimately your purchasing power.
Yeah, nobody wants that.
Nobody wants that.
Okay, but here's the counterpoint.
Okay.
Tilbury suggests that Trump, with his business background, might be playing this high-stakes game.
Oh, interesting.
That maybe these tariffs are actually a tactic.
Like a negotiation.
A way to force more favorable free trade deals.
Do you think that's possible?
Honestly, it's tough to say.
Yeah.
But what's really interesting is how Tilbury brings this back to market psychology.
Oh, yeah.
This constant uncertainty, this not knowing what's going to happen next.
Right.
It really spooks investors.
Makes sense.
And when investors get nervous, markets tend to react.
Oh, yeah. Not always in a good way.
Not always in a good way.
Not always.
And that kind of leads us right into Tilbury's second trigger.
Okay.
NATO.
NATO. Okay.
Trump's stance on NATO has been unconventional. Unconventional, we'll just say that, he's questioned its relevance, demanded more from allies.
Yeah.
And, it throws another wrench into this whole global stability equation.
It does. And Tilbury really highlights those ripple effects.
Right.
If NATO weakens, does that embolden Russia and China?
Oh, gosh.
Right? Does it lead to more geopolitical tension, maybe even conflict?
Yeah.
And then what does that do to things like military spending and energy prices?
Yeah.
It's all connected.
It's like a domino effect.
Total domino effect. And all of those factors play into market stability.
Oh, yeah.
And ultimately your investments.
Right.
So, it's not just about some abstract political debate here.
No.
These are forces that can directly impact your financial well-being.
Absolutely. So we've got tariffs potentially messing with trade and consumer prices.
Right.
We've got this NATO uncertainty shaking up global stability. Are you ready for trigger number 3?
Oh, boy, lay it on me.
Okay, so Tilbury proposes that Trump might be intentionally orchestrating a market crash.
Whoa.
His goal,
okay,
to force the Federal Reserve to lower interest rates.
That's a big theory.
It's a wild theory.
Yeah.
But, when you think about Trump's aversion to high interest rates and the U.S.'s massive national debt, it starts to make a twisted kind of sense.
Yeah, it does.
And Tilbury uses this great analogy.
I love analogies.
He talks about a credit card.
Okay.
Imagine owing, say, $365,000.
$365,000.
On that card at a 10% interest rate.
Ouch.
Ouch, right?
Yeah.
And in this analogy,
Okay.
the U.S. government is the one holding that massive credit card bill.
Right.
So even a small drop in interest rates could save billions
Billions.
in interest payments.
It's a bold move, though, isn't it?
It's incredibly risky.
Intentionally crashing the market to manipulate interest rates.
Right.
I mean, what would even the fallout be from that?
Well, there are definitely two sides to this coin.
Yeah.
Tilbury argues that if it works,
Uh-huh.
it could be a financial masterstroke.
Yeah.
But if it backfires,
Uh-oh.
well, let's just say there would be consequences.
Yeah.
And that's exactly what we're going to dig into in part 2.
Okay.
We'll explore the potential fallout from these triggers and, most importantly, what you can do to navigate this potential storm.
Can't wait.
All right, see you in part 2.
Sounds good.
Okay, so we've explored some pretty heavy stuff so far. Trade wars, a shaky NATO, and even the possibility of a Trump-engineered market crash.
Yeah, a lot of doom and gloom.
Right, it can feel kind of scary.
Yeah.
But remember, Tilbury's analysis isn't about predicting the future.
No, not at all.
It's about helping us understand, what could happen so we can be prepared.
Exactly. And one thing he really emphasizes
Yeah.
is that historically, every market crash has been followed by a recovery.
Interesting.
And he actually sees these downturns as opportunities to buy assets at a lower price.
So instead of panicking when the market dips, we should be looking for buying opportunities.
That's the idea, but there's a catch.
Okay, a catch.
To really take advantage of a downturn, you need to have your financial house in order
Okay.
before the storm hits.
So what does that mean practically?
Okay, well, first and foremost, make sure you have a solid emergency fund.
An emergency fund.
Right, that's like 3 to 6 months worth of living expenses,
Okay.
tucked away in a safe, easily accessible account.
Okay.
This gives you a cushion
Uh-huh.
if you lose your job
Yeah.
or face unexpected expenses.
Right. It's like having a safety net.
Exactly.
So you don't have to make rash decisions with your investments if things get tough.
Exactly.
What else?
Next, tackle any high-interest debt you might have.
High interest debt.
Credit card debt,
Yeah.
payday loans, things like that.
Yeah.
The interest payments just eat away your income,
Yeah, they do.
making it so much harder to build wealth and take advantage of those opportunities when they arise.
So basically shore up your defenses, right? Get that financial foundation strong.
Yes.
Before you venture out into these potentially turbulent markets.
I love that analogy.
Yeah.
And once you've got that foundation,
Okay.
Tilbury recommends a strategy called dollar cost averaging.
Dollar cost averaging.
Have you heard of this?
I have heard of it, but I think a lot of our listeners might not be familiar.
Yeah, so it's really simple, but super effective, especially in volatile markets.
Okay. Break it down for us.
All right, so it's basically investing a set amount of money
Okay.
at regular intervals, regardless of what the market is doing.
Okay.
So let's say you decide to invest $100 in specific stock every month.
Okay.
Some months the price will be higher, some months it will be lower.
Right.
But by investing consistently,
Mm-hmm.
you average out your purchase price over time.
So you're not trying to time the market or guess when prices will be highest or lowest.
Exactly.
Got it.
Trying to time the market is like trying to catch lightning in a bottle.
Yeah. Good luck with that.
It's incredibly difficult.
Yeah.
And often leads to more losses than gains.
Right.
Dollar cost averaging takes the emotion out of investing, and it helps you ride out those market fluctuations.
This sounds really practical,
Yeah,
especially if you're not like a seasoned investor.
absolutely.
It seems like a way to kind of dip your toes in
Yes.
without taking on too much risk.
It's a great starting point.
Yeah.
And it ties into another key point Tilbury makes.
Okay.
Diversification.
Ah, yes. The old don't put all your eggs in one basket.
Exactly.
If you put all your money into one type of investment and it tanks, you lose everything.
You lose everything, but if you spread your investments across different asset classes, you're less exposed to any single risk.
So what are some of those asset classes we should be thinking about?
So you've got your stocks, of course,
Okay.
which represent ownership in a company.
Right.
Then there are bonds, which are essentially loans
Okay.
you make to governments or corporations.
Got it.
You've also got real estate, precious metals like gold and silver,
Yeah.
and even newer asset classes like cryptocurrencies.
So many options. It's almost overwhelming.
It can be,
Yeah.
and that's why it's often helpful to work with a financial advisor.
A financial advisor.
Someone who can help you create a diversified portfolio
Right.
that aligns with your risk tolerance and financial goals.
So even if a market crash happens, a well-diversified portfolio can kind of help cushion the blow.
Exactly. And Tilbury even has a suggestion for an asset class,
Okay.
that tends to perform well during market downturns.
Oh, tell me more.
He recommends looking into dividend-paying stocks.
Dividend-paying stocks.
Yes, these are stocks of companies that regularly pay out a portion of their profits
Okay.
to shareholders.
So even if the stock price goes down, you're still getting some income from those dividends.
That's right.
Interesting.
It's like having a steady stream of income coming in,
Yeah.
even during those stormy market periods.
Okay. I'm feeling a little less anxious now.
Good.
It seems like there are things we can do to prepare for a potential crash. But I'm curious, what are Tilbury's thoughts on those specific triggers we talked about earlier?
Right.
Does he have any advice for navigating, say, a trade war or instability with NATO?
That's a great question, and something we'll dive into in part 3.
Okay.
We'll explore how those geopolitical events might specifically impact your investments
Got it.
and what steps you can take to adapt.
Sounds good. Stay tuned for part 3, where we'll continue our depth dive into Mark Tilbury's analysis.
Yes.
And explore even more strategies for building financial resilience no matter what the future holds.
All right, so we've covered so much ground in this deep dive: trade wars, a wobbly NATO, and that really bold theory about Trump, intentionally causing a crash to manipulate interest rates.
It's
a lot.
such a process, yeah.
It is. But you know what I find so impressive about Tilbury's analysis?
Yeah.
Is how he connects all these seemingly separate events, back to your personal finances.
Right.
He doesn't just talk about abstract economic theories. He makes it real, relatable.
I agree. I especially like that credit card analogy. Oh, yeah, me too.
It really helped me understand the potential impact of those massive interest payments on the national debt.
It was a good one. It really highlighted why this secret plan theory, while risky, might actually be tempting for someone in Trump's position.
Yeah, for sure. But let's shift gears a bit. We've talked a lot about preparing for a potential market crash in general.
Right.
But what about those specific triggers that Tilbury outlines? How can we actually apply what we've learned to those scenarios?
Good point. So let's start with the trade wars. If those tariffs keep escalating, what are some practical steps we can take?
Well, remember our discussion about diversification.
Yeah.
That becomes even more crucial in a trade war scenario.
Oh, okay.
Tilbury suggests looking for companies that have a diverse range of suppliers and markets.
So instead of putting all our eggs in one basket,
Right.
we spread them out across companies that aren't heavily reliant on any single country for
Exactly.
their operations.
Yeah, it's all about managing risk.
Yeah, makes sense. And what about that potential for a weakened NATO? An increased global instability.
Right.
How does that play into our investment strategy?
That's where understanding those different asset classes comes in.
Right.
Remember how we talked about gold and silver as those safe haven assets?
Yeah, they tend to hold their value or even increase in value when things get really uncertain, on the world stage.
Exactly. So in a scenario where geopolitical tensions are rising, having a portion of your portfolio allocated to precious metals can provide a sense of stability.
Right.
It's not about getting rich quick. It's about preserving wealth during turbulent times.
Okay. So diversify our holdings. Consider adding some precious metals to the mix. What else?
Tilbury also really encourages us to stay informed and be adaptable. Keep an eye on those global events. Try to understand how they might impact specific industries, and just be prepared to adjust your investment strategy accordingly.
So don't just set it and forget it.
No.
But stay engaged, do your research,
Yes.
and be ready to make changes as needed.
Exactly. And, while we've been focusing on the potential downsides,
Yeah.
Tilbury also sees opportunity in all of this.
Right. He actually encourages us to view market downturns as potential buying opportunities.
Yes.
It's that whole idea of be greedy when others are fearful.
That's it. And that's where having that strong financial foundation we talked about earlier becomes so important. If you've got your emergency fund minimal debt, you're practicing dollar cost averaging.
Right.
You're in a much better position to seize those opportunities when others are panicking.
So at the end of the day, it's not about predicting the future. It's about being prepared for whatever comes our way.
I love that.
And Tilbury's analysis has given us so much to think about.
It really has. We've explored some pretty complex economic and geopolitical scenarios.
We have.
But the key takeaways are actually pretty simple. Build that solid foundation, diversify your investments, stay informed, and be ready to adapt.
That's a great way to sum it up. Knowledge really is power,
Yeah.
especially when it comes to navigating these uncertain financial waters.
Absolutely.
So as you continue your financial journey, remember what we've discussed today. Do your research, make informed decisions, and most importantly, don't panic.
Don't panic. The best time to prepare for a storm is before it hits.
That's so true. Thanks for joining us for this deep dive. We'll see you next time.